Welcome to How to Trade Credit Spreads for Fun and Profit, because winning is always fun. So my name is Peter Schultz, and I'm the founder of Wealth Builder Publishing and thewinningsecret.com. And right now I'm going to show you the best kept secret in the entire world of trading. You see, options can be very profitable. The problem is most people trade them the wrong way. Most people buy puts and buy calls, and in doing so, they think they bought the winning lottery ticket. But oftentimes they find out they really bought the losing ticket. And I can show you how this works statistically. In fact, we're going to talk about that in a minute. And for years, I was this guy in the picture. I bought options. I did all my research. I looked at the chart. I thought I was going to make $1 million. And a crazy thing happened. Expiration came and went, and I lost my money. One day I woke up and I thought, who's collecting all that money? Is there some big pile of cash that's just accumulating somewhere, getting bigger and bigger and bigger? Where is all that money going? And it finally dawned on me, like this huge revelation. The people that are getting all that premium that people spend on options are the option sellers. The trick to making money quickly, easily, and consistently in spite of the market or the economy or yourself is to stack the deck overwhelmingly in your favor on every trade automatically. The way we'll do that is to switch from being an options buyer to being an options seller. And by doing so, we'll instantly stack the deck by over 80% on every trade automatically. Now, the beauty of this strategy is that it has nothing to do with you. It doesn't matter how quick you are on your mouse, or how willing you are to watch the markets, or whether you're willing to watch every uptick and downtick of the market until you're ready to be hauled out screaming obscenities at the world. It doesn't matter, because you don't have to do any of that with this strategy. One of the most beautiful things about this is it's so darn hands-free. So my dream for years and years and years was being able to make money in the market without having to watch the market so closely. Because frankly, life is exciting. There's a lot of things to do. There's a lot of world to see. There's traveling. There's good work to do. There's all kinds of things. There's your family. There's all kinds of things that are more interesting and more productive than going crazy watching the market jump up and down. So let me show you what I mean. To get the highest odds of success with the biggest potential profit. So here's what a credit spread is. And so let's just explain it. And even if you know what it is or think you know what it is, I think you might learn some new things here. So this is one of our actual trades from my subscription service that I think you'll want to take advantage of. And I give you commentary right here in the chart. And this talks a little bit about the stock and why it's going down and kind of the technical picture. But I also give you this big write-up about the fundamentals and why it's heading in the direction it is, and also what's going on with the overall market. So as you can see, this stock is in a very obvious downtrend. And so what we're going to do is we're going to go just above resistance. So this is obviously the resistance line going down. The stock doesn't seem to want to trade above that. And we sell this option right here. And we can do that without owning it. You can actually sell an options position to open the position. It's done every single day. It's very, very normal. And I'll show you how to make that trade. You just right click and you select sell instead of buy. So you sell it to open a position and you get a certain amount of money. Of course, we always get money when we sell something, even if we don't own it. So we sell it, we take in a bit of money, a chunk of money, a decent chunk. And then so that we don't have risk going into the stratosphere, we hedge by buying this option, and this option costs less. And the reason it costs less is it's further from the underlying stock. It's further from the price of the underlying, so it has less chance of getting hit. So because we take in big dollars on the one that we sell, and when we buy to hedge to protect ourselves, we're taking in smaller dollars, it creates a very nice credit in our account. So on a typical spread, what we're going for, and let's say we're going to do a $5 spread, and with an expensive stock, it's going to be around $5. With a cheaper stock, we're going to do it for more, around $2.50. But let's just say it's a $5 spread between these two, $5 in price. So what our goal is to take in $1. So if it's a $5 spread, here's some very simple math here. So it's a $5 spread. We take in $1 in credit. Now, the cool thing about options is options come in 100 share contracts. And so if you take in $1, you get $100. So you get to decide how many $100 bills you want. If you do 10 contracts, in this scenario, you get $1,000. And I know people that do a lot more than 10 contracts. I do a lot more than 10 contracts. But if we make $1 on a $5 spread, that gives us a $4 potential risk. So that dollar that we take in, we get to keep no matter what. That's ours. That's ours to keep forever. So if we make a dollar on a $4 risk, that equals a 25% return. Can you see that? $1 is 25% of $4. So $4 is our maximum risk. We're taking in a dollar, and so that's a 25% return if expired worthless. And I'm going to show you a way to mitigate that $4 so we probably will never lose that much money. I'm going to show you a really effective way to do that automatically where you don't have to watch your position. So just take a look at this scenario for a minute. We have the potential of making 25%. The stock is heading lower, and it might bobble around a little bit. It'll probably go lower. And if it expires, if these options expire, and the really cool thing about this is here's your finish line. So what I love about options is you don't, when you sell them like this, you don't have to worry about when you get out of the trade. It'll all happen automatically because in about 9 days' time, these options will cease to exist. And that's about the amount of time we sell. And you take out a weekend there, you take out 2 days. So that's really only about 7 days or 8 days of actual market risk where the position is out there. So we do a lot of things to increase our chances, but this is a pretty darn good return in 9 days. If you start turning 25% every 9 days on a regular basis, get out a calculator because it's some of the most inspiring math you'll ever see. So on this particular write-up, this is RH, just happens to be a stock that's heading lower. And traders sold RH with a vengeance after their earnings, and the stock has been trending lower ever since. We'll be selling above resistance with first support at 265. So the stock had a lot further to fall. So let's see what happened with this one. Well, here's what happened. It's kind of about what you would expect to happen. The market was heading lower. This particular stock was heading lower. Here's our expiration date. So we ended up keeping the entire 25%. Now, if we get a little more than $1 on a $5 spread, that's going to be more than 25%. Occasionally, we'll take in 90 cents if the setup looks really good. So we'll take a little less, but that's our target, 25%, and often we do better. So let's see what else we could have done. So this is another stock, and here's the write-up. It really crashed after earnings, tried to recover, and now it's rolling to the downside. Weakness in the fundamentals tells us that that trend is likely to continue. So we collected 50 cents on a 250 spread. So that is the equivalent of $1 on a $5 spread. So once again, it's 25% if it expires worthless. Well, in just 1 day. So we actually did this trade, and you can see right here when the stock was here, this kind of little green bar right here, and you can see when we initiated the trade. Well, the very next day, the thing fell like an absolute rock, and it was worth just 17 cents after 1 day. You know, if you're prudent and you're conservative, you can close the trade right there. And a lot of my subscribers do. They don't wait until expiration. They would rather have a much, much higher win ratio where they just win all the time with a very, very rare and occasional loss. I'm a little lazier than that. I like to just let the thing go, and I want to get that maximum return out of the position. And also, you know, we watch the fundamentals pretty well. So this thing was definitely trending lower. It broke some critical support right here, and we sold above that support. We sold an option here, we bought an option here, and we collected a really nice premium. And once again, this one expired for maximum profits. Here's happened to be the Russell 2000 at a time period when it was really trending lower. And we sold a credit spread here, sold this option, bought this option, took in a really nice credit. We sold this option a little while later, bought this option. This first one was for 35%. So we took in more than $1. And this next one, believe it or not, we brought in 40%. So once again, we try and do better than our minimum. And when the market really gives us a chance to, we do. And what happened is, as you can see, where this spiked higher, that's when we sold this spread. So we got 40% on it. And this one happened to spike higher, and we took advantage of it, and we got 35% on this one. So very consistent downtrend, very predictable market, not a lot of bright spots on the horizon. And yes, occasionally you'll see a bounce, but as you can see, it's right here within our channel. And we're selling outside, way outside of the money. And in this case, when we're selling call spreads, so these are call spreads, what we're selling is calls. We do that on a downtrending market, and this works just as well on an uptrending market. And in that case, we sell puts. So we sold a put here, we bought another put here, we collected a really nice credit. And look, you know, this one was just going sideways. It had really strong support right here. Kept bouncing off the support. I figured, you know what? We had a big uptrend here. A lot of the time these uptrends reassert themselves after the stock goes sideways for a while. So I thought, fairly safe to sell below this really strong support. We had a little spike lower here. So we got some really good credit on selling this particular put spread. And sure enough, the thing just bounced and it expired worthless for a maximum profit. So this is what we do. This is selling credit spreads. We sell a short amount of time, just that 9 days typically. Sometimes we have to lengthen it out a little bit to a couple of weeks if we want to get more credit, and there isn't a lot of credit available. But this is what we pretty much shoot for, is this 9 days, because it gives us the maximum amount of time decay. So one of your guarantees in the markets is that options are going to continue to decay until they finally expire. And if they're out of the money, and that means they're not inside of any of these strikes here, they're going to expire worthless, and we're going to get to keep 100% of that profit. So it's a pretty sweet deal. It's a pretty high odds deal. And it's also a pretty hands-free deal. So here's why this works so well. So there's only 5 things that a stock can do. So let's say, let's say that we've decided that this has a downtrending channel, okay? And we decide this is about at the top of its channel, and we want to sell, maybe we want to sell an option that's above this. Let's say that's the case here. We think it's going to roll over. Well, there's only 5 things that a stock can do. From here, it can take off like crazy and just go straight up. It can go up, but it can go up at kind of a leisurely pace. It can go sideways. It can just trade sideways. It could go down, but not dramatically, just kind of drift down a little bit. Or the stock could absolutely crash and go through the floor. So these are our 5 scenarios. So if we're selling a credit spread above, so this would happen to be a call spread up here, if we're selling it above and we think the stock might roll over, so this is what we're selling. We're going to make money if this thing goes down. We're going to make our maximum profits. And if it just goes down a little bit, we're going to still make our maximum profits. And you know what? If the stock trades sideways, like we saw in our last one where it just went sideways for a while, we still make our maximum profits. In fact, even if it goes against us a little bit, but it's not dramatic, we still make our maximum profits. So the only way that we're going to lose is if this thing goes dramatically higher. And we'll just put a slash through that because maybe we didn't make any profit on that one. Maybe we had to take a little loss. But as you can see, your odds are pretty darn good. If you're trading with the chart, you're trading with the fundamentals, you're trading with the overall market, and you're selling something where you just don't think the stock is going to go. And I'll tell you a big trick and a big secret to this strategy. And here it is. It's a lot easier to figure out where a stock is not going to go than where it is going to go. So if you buy a straight put or a call, you have to figure out kind of exactly where that stock is going to go. And worse than that, you have to get the timing perfect. And if you're off on a little bit on either one of those, you're going to lose money. And I proved it. I used all my fundamental analysis, all my technical analysis, everything I could for years buying short-term puts and calls and just lost money consistently and consistently. And finally, I woke up one day and this big light bulb goes on and I said, you know what? I want to be a collector instead of a contributor. And boy, this turns you into a collector. The minute you put on the trade, you collect the money, it shows up in your account, and that money is yours to keep no matter what. The only way you can lose on this is if you have to close a trade early, and that is going to cost you more than you took in. But as I'm going to show you how you can mitigate those losses. But the really cool thing about this particular style of trading is if you think about all the investing that you've ever done in your entire life, did you ever get a percentage probability that it was going to work or not work? Well, no. I mean, you buy an investment piece of real estate, a duplex or whatever, you think it's going to work okay. You don't know what your probability is. You don't know what your chances are. And for that matter, you don't know when you're buying a stock. Well, with this, you do. So I'm going to show you how to set up your Thinkorswim account. Thinkorswim is the best broker in the world for trading options. They have the best platform. And I'll even show you how to set up there's really cool things you can do, like you can paper trade through the platform before you ever spend real money, so you can really get used to it. But in the particular example, or what we're looking at here is we're selling, so we think this is going to go up. So we sell the 360 put, so we're over here on the put side. So we think this thing's going to go up, and it's like 368 or something, and it's rising. It's in a rising market. So we sell this 360 put, and we bring in a certain amount of money. And I'm going to show you how to set up the columns on your trading platform to see this right here. This is probability of out of the money, OTM, out of the money. When an option expires out of the money using this strategy, you get to keep it's a maximum profit trade. So to hedge, we're buying the 358. So in this particular instance, this is a $2 spread. And, to get your 25%, that's now only 40 cents. 40 cents divided by $1.60 is our 25%. But what we're really concerned about right now, we know we can make a lot of money. What we're concerned right now is how consistent that money is and how safe it is. So as soon as you start playing in the world of options, there's huge profits to be made. The question is are you going to win? This is a really, really important question. This is, what is your probability of winning? This is what the professional traders are always asking themselves. If you show me somebody that's been in the options market for over 5 years or over 10 years or especially 20 years, I can almost guarantee you that they're an options seller, because that's where the consistency is. So how are we guaranteed, or how are we mathematically guaranteed of an expectation of winning? Well, it's confirmed by the Black-Scholes options pricing model. And this model was so good, it won the Nobel Prize for the economists that created it back in 1997. Now, this prize was given quite a few years after they created the model. They created it back in 1973, and it's literally, this options pricing model is literally what made the options market possible today. Before that, they had no way of pricing options. They didn't know what a fair value is. This thing is all plugged in now. It's all computerized, and it gives you automatically your probabilities of winning. So we typically don't do a trade with less than an 80% chance of winning. In this particular case, it's 80.04%. Now, I have a question for you. If a friend of yours took you in the backyard and said, you know what, I'm going to flip this coin, and you can go ahead and call heads, and I'll tell you this is a special coin. I got it at the novelty store, and it's going to turn up heads 80% of the time. And by the way, since we're going to do 10 contracts here, and I don't suggest you start off with 10, start off with paper trading or even one contract until you get the hang of things. But let's just say you're experienced and you're going to do 10 contracts. So every time I flip this coin and it comes up heads, your friend tells you in the backyard, I'm going to hand you $1,000. And I'm going to ask you right now, how many times should you stand in the backyard and have your friend flip that coin? And I would suggest you'd probably be out there until it got dark outside and you couldn't even see the coin anymore, because 8 out of 10 tosses, he's going to hand you $1,000. So a really good question to ask at this point, and this might already be going through your mind, is that's great. You've talked about the winning side, and you made it sound really good. And I'm, excited, tentatively, but I want to know what you can lose, because in the markets, things at some point or another, I don't care what your expectation of winning is, at some point it's going to go against you. So what happens when you lose? Well, let's just take a look at that right now. So we expect to win on 8 out of 10 of our trades. That's what the mathematical formula tells us. And we're going to even stack the deck even more in our favor by looking at the chart, looking at the fundamentals, look at what's coming up. Really try and stack the deck as much as we can. We often win more than that. I've had entire months, we do 2 trades a week, and that's 8 trades a month. I've had entire months where we didn't have a single losing trade, but I don't think we should base our expectations on that. Let's be a little more realistic. So let's say we win on 8 out of 10 of our trades. So, and we win 25% every time we win, okay? So that's 1 win, 2 wins, 3 wins, 4 wins, 5 wins, 6 wins, 7 wins, 8 wins, okay? And we are trying our 25% on a $5 spread, say, is we're trying to make $1, okay? Now, I know $1 isn't much money, especially nowadays, but the cool thing about options is you multiply that, right? So one contract is 100 shares. So if you get $1 on just one contract, one measly tiny little contract, you get a $100 bill if you win. If you do 10 contracts, you get a $1,000 bill. If you do 100 contracts, you get $10,000. So as you can see, there's a lot of money to be made. Now, what's going to limit you, the limiting factor, is your broker is going to hold that other $4 as margin in your account. So if you have the possibility of making $1,000, your broker is going to hold $4,000 until you either exit that trade or it expires worthless. So just keep that in mind. You can't do an infinite number of contracts because you're going to be limited by your account size. But what we can see here, what's really simple, is if we went on 8 out of 10 trades and we're making $1 on each trade, we're making a total of $8. Okay, now what's important here is to see what we can lose. So we're going to lose on 2 trades. So on our 9th trade, we lose. Now, how much do we lose? Okay, so options theory tells us that, and what your broker's going to have you set aside is that $4. So there's only $5 of possible loss here, but that dollar credit that you got, you get to keep forever, no matter what. That's yours to keep. That's permanent. So the most you can lose is $4. So on our the two trades that we lose on, we lose $4 on this one, and on our 10th trade, we lose $4 on this one. Okay, so what is that total? Oh my goodness, that's kind of crazy. It looks like we're going to lose $8. We're going to make $8 over here. We're going to lose $2 over here. Peter, what the heck are you even showing me this for? This isn't a very good strategy. This looks like just a whole lot of trading for break even. Here's the secret. And it's right over here. This lose with an auto stop. So the way options theory works is you have two strikes here, and there's a $5 spread in between. You know, we sell this one and we buy this one, right? Well, here's the thing. The stock, in this case, this would be a call spread because we think the stock's going down. And this is just for illustrative purposes. This works just as well with calls and puts, which is another reason I like this, is it's totally market agnostic. We don't care if there's bulls or bears running the show. We can always make money. But in this case, let's say the stock is going down, market's going down, and it's going like this, right? We draw our little trend line and we say, you know, we're going to sell this spread. We think it's going to do pretty well. Well, here's what happens. Some great news comes out that we weren't anticipating, and this thing just shoots higher. Well, here's what I'm going to show you how to do, which is so unbelievably cool. I'm going to show you how to set an automatic order with Thinkorswim that immediately closes this spread, closes the spread the minute the sold strike is touched. So we're not going to let this thing go all the way through both strikes. That's what would cause the $5 loss. So options theory tells us, and this is pretty good, this goes back to the Black-Scholes model, so we know we can depend on it, is when this sold strike is touched, the cost to close this position is 1/2 the distance between the strikes. So now the cost to close isn't $5 anymore, it's $2.50. Now keep in mind that we already took in $1, okay? And they can't take that dollar away from us no matter what. If we take in more, this equation gets even better, but let's just stick with our $1. So the maximum we can lose once we set this automatic stop is $1.50. Now I understand there can be gaps in the market and so forth, but that's usually not what happens. It's very rare you get a gap, especially with something that's very liquid, like a big index. But you know, occasionally things can happen, but we're just going with the 90-something% of the time that the market is actually working properly. So this is a $1.50 loss. So let's take our 9 and 10 right here, and instead of having a $4 loss, we've got automatic orders. And by the way, sometimes when things get sketchy, I'll send out an email and I'll say, you know what, you guys, let's close this thing early. I don't like the way the market's looking. Let's not wait for our stop to get hit. Let's get out. A lot of the time, if there's been some time decay, we actually get out at a profit by closing early. But let's say we weren't paying attention. You know, I don't want to watch the markets all the time. We're out doing something really fun. We're playing pickleball, we're climbing a mountain, we're hanging out with our friends, we're out on the lake, we're doing whatever, and our stop gets hit. And on those two trades that don't work out, we lose $1.50 on one and $1.50 on the other. And now, instead of an $8 loss, we just reduce that to a $3 loss. Now, we're making 8, we're losing 3. Does the equation start looking better? So, what can we expect to lose? Well, and win. So once again, this is $8. Now we don't get to keep the whole 8 because the market has its way with us. And so we lose 3. So what do we end up with? We end up with, obviously, what our mathematical expectation is to make $5 on 10 trades. Now, if you're just doing one contract, if you're doing the absolute minimum, if you have a super tiny account, you can do this with about a $1,000 account. I mean, you're only talking about a $400 margin hold, and with $1,000, you can do 2 trades a week. I mean, I recommend you have more in your account, but I mean, you don't have to be a rich guy to do this. But on 10 trades, that equals, with just one contract, that's $500 a month. Now, anybody here that's watching this certainly has enough money to do one contract per trade. And could you use an extra $500 a month? Most of us could. Now, you jump that to 2 contracts. Obviously, that's $1,000 a month. If this math works out, obviously, there's no guarantees, but a Nobel Prize winning formula says that this is how it's going to work out, and this is kind of how it works out. As you can see, that's just 2 contracts to get 1,000. It doesn't take much of an imagination to increase your number of contracts with the mathematical expectation of winning, with always setting your stops and paying attention to everything, and also watching what I write in the newsletter, because I'm here to protect you and make sure that you make money to the best of my ability, and I've been doing this for a long time. As you can see, when you up this to 5 contracts or 10 contracts, 10 contracts comes to a cool $5,000 a month, which I think all of us could make some good use out of. So the math starts getting really compelling. And what I love about the math is it's got nothing to do with you or I. It doesn't have anything to do with whether you're old or young, or whether you're male or female, or whether you're black or white, or whatever religion you are, or your background, or if you had a college education. This is open to anybody. They don't ask you those kind of questions when you go to open a brokerage account. You could have a big purple horn coming out of your forehead, and you could you could be, whoever, and still open a brokerage account and do this, especially if you follow my instructions and have a mathematical expectation of winning. So if you made $8 but had to give back $3, would you take that deal? We get a whole lot of $5 bills out of this thing. And so this is the only strategy that I've seen that hands you a mathematical expectation of winning. And I love that, because it has nothing to do with, how sharp you are, or how handsome you are, or how tall you are, and all these other, precursors to success. If you can follow directions, you can do this strategy. And that's all you need, is a mathematical expectation of winning to make a lot of money in the markets quickly, consistently, and safely. And I've done it. I've been doing this for over 20 years, and we've been doing it successfully and teaching just regular folks, some of which who have never traded before, how to do this and be successful. And even if you are a really experienced trader and you really get into the technicals and you have lines all over your chart like somebody threw spaghetti at it, wouldn't you love to have a strategy always working in the background that's making you money that you really don't have to watch? And maybe with the majority of your money. Something that's consistent and safe and fairly quick. I mean, you can churn these deals, like I say, every 9 days. Now, this only works if you know what you're doing. And if you're already an expert on credit spreads, go out there. I hope this presentation has inspired you. I want you to go for it and make a lot of money. If you don't have a lot of confidence, I'm going to give you right now the best deal in the trading world, because the tiny amount I charge for this incredible package, you can pay for with just one trade, and you've got a year of the service. And let me show you what you get. It's quite incredible. I put together just an incredibly effective training package. I've been working on this for years. I keep adding new things to it as we discover more. And this package will help you start off profitably from the very beginning, so you don't quit, so you stay inspired, and stay profitable. So this package is called The Winning Secret, and it includes a 161-page downloadable ebook. It's complete with color graphs, charts, pictures, everything you need to start trading profitably and stay that way, plus a 10-chapter video series where you can hear and see exactly what to do to start generating income. You'll also gain access to our archived webinars and video tutorials, so you can discover new strategies and ways to improve your returns and limit your risk. And you have access to all new editions of this educational package for life as an owner. Plus, you'll see videos that show you how to set up automatic orders with our favorite broker for spread trading to automatically trap profits and limit your losses, whether you have time to watch the markets or not. And with your subscription, now this subscription is, I think, $99 a month. It's incidental because the market's going to pay for it if you do even a couple of trades a month. But I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. And once again, I'm very confident this is going to work for you. There's obviously no guarantees, but it's worked for over 20 years and it's going to work for the next 20. I'm confident because the math tells us it's going to. So as an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. It's the best thing that happened to options ever since they started to be traded in 1973. They started with weekly options in 2012. They keep adding. Every stock doesn't have them, but the most liquid stocks that really trade a lot of options do. And it's great because it just increases your frequency of getting paid. You can set up weekly paydays instead of the old days you had to have monthly paydays. So that's pretty sweet. Now, I understand that when you get into a new website, and you start clicking around and trying to learn everything yourself, it can be kind of hard. So I want to introduce you to Deanna. She's been working for me for many years. She's an absolute sweetheart, and she's really cool at taking you through your new subscription. This is one-on-one service. This isn't you can talk to her on the phone. She'll orient you on your computer. She'll show you what to click on, where to go, to really make sure you get your account set up the right way so you can actually trade the strategy. By the way, you can trade the strategy in an IRA, either a regular IRA or a Roth IRA, which I regularly do, and it's like tax-free income. It's super, super sweet. So she's going to show you how to best take advantage of all you get in this package, how to set your account up, how to, orient yourself so you're really confident and you really have somebody holding your hand here. And this is like one-on-one. It's not a class or anything. She's here for you. I wanted you to get some personal attention. But the real personal attention, the really cool attention, is going to come from this gal right here. This is Alicia. She graduated in finance from our local university here. She is sharp as a freaking tack. This is the gal that I go to when I'm coming up with a new option strategy and really trying to figure out how to work it. She's got a mathematical mind that can figure out the probabilities in her head. She's absolutely incredible. She's made more of her subscribers more money than probably any other single person besides myself in the company. And she does our personal coaching sessions. And you can sign up for those. Yeah, they're on the website. We have 3 session packages. We have 8 session packages. But I'm going to include your first session in this package so you can see how good she is. You can see how profitable she is. And that's a 45-minute personal coaching session. You'll also love her personality. She's super, super cool. And this session is going to designed to increase your knowledge, your confidence, and most of all, your profitability. So I can't say enough good things about her. She's been with me for over 10 years now. And I just have a lot of respect for her intellect and her ability to make money for our subscribers. So I really want you to take advantage of what she's got to offer. I put together a package. This is well over $1,000. I think it's around $1,400-1,500 for everything. But I put together a package that is so reasonably priced. I think anybody can afford this. I'm not actually even going to tell you what it is. I want you to go here to worryfreeprofits.com and really take a look at everything you get. I think it's going to blow you away. And I think the price that we're offering this at is going to blow you away. I'm going to include your first month subscription. That's included in the package. And I figure after your first month, you'll be making these trades. And the whole idea is to let the market pay for your subscription going forward. I never want you to come up with anything out of your own pocket once you get going. So go ahead and check that out. It's worryfreeprofits.com. Looking forward to having you on board. There's a lot included in this package, things I couldn't even talk about, but mainly you get support. And what I love is new people coming on board because we sort of become friends over time and people come on the subscription service. And if they start trading it, they never leave. The only people that ever quit are the ones that just didn't get around to started trading it in the first place. But you do a few credit spreads and it's going to make a believer out of you. So I'm looking forward to seeing you inside the site and making some money together, trading credit spreads for fun and profit.